this afternoon. Today we're going to be talking about generating consistent income with options. And this is a webinar that some of you will probably have seen before. But today we do have some additional information to share with you guys. We've been crunching a lot of numbers because people have been asking us about performance numbers. You know, how has the performance of options plays recommendations been doing? So we've been hard at work at crunching all the trades that you guys have been looking at, including what financial advisors have been using this platform to find covered call opportunities for their clients. What we've been doing is we've been aggregating all of those trades and getting some of those performance numbers. So we're happy to share those with you today, on top of talking about the concept of using covered calls to generate income for your portfolios. So for those of you that are new, welcome. This webinar will be focused on teaching you some of the basics of covered calls, showing you how each one of you can individualize them for your portfolios. But most importantly, what we really want you to guys be able to walk away from this webinar is having the tools so that you can confidently log into Options Play to be able to use to find the income opportunities for your portfolios very quickly without having to do a lot of work on your end. So that's why today we're going to be talking about how to use the Options Play platform along with what you learn to go through some real-life examples of finding covered call or income opportunities. And then at the end, we're going to open this up for Q&A so that we can answer any questions you guys have regarding covered calls or specific income strategies that you want to look at on an individual symbol. So again, I'm just going to leave this up for 2 more seconds. If you guys cannot hear me or having any audio issues, please dial into the conference line. You'll be able to hear me there if you can't hear me through the computer. So today we're going to talk about, just like the other webinars, we're going to cover some of the basics about covered calls, basics and benefits so you guys can understand, especially for those of you that are new. Actually, before I get started with the topic, can those of you that are in the chat window type in yes if you are familiar with covered calls, or have traded, type no if covered calls is a new income strategy for you. Okay, 1 no, mostly yeses. Great. Okay, so most of you are familiar. 1 of you are new, which is okay. A couple of new users that are new to covered calls. Great. So we'll cover some of the basics for those of you that are new. But today we're going to talk about, again, we want to share with you the information that we've crunched in terms of the performance of covered calls that we've been recommending to users that you've been finding on Options Play. We're going to talk a little bit about individual preferences, and the reason for that is because, again, covered calls is not a one-size-fits-all strategy. Each one of you has different portfolio sizes. Each one of you trade different in terms of how frequently you trade, and each one of you has different risk tolerances. So we want to understand how each one of you fall under those preferences so that you can find the covered call or the income opportunities that suits your portfolio. And then once you understand those individual preferences, we're going to talk about the 2 crucial steps to generating consistent income, which are actually quite easy once you understand your individual preferences. And then lastly, like I said, the most important piece of this is helping you guys to actually not only understand it, but be confident enough to log on to Options Play and be able to quickly find the income opportunity that suits your portfolio. So we're going to show you how you can automate that process using Options Play. So we'll go through some real-life examples of finding covered call opportunities on real stocks using real-time prices, and then show you how you can do it yourself very quickly using our platform. And then lastly, we'll talk about exit strategy, how you can manage your covered calls once you're in those covered calls. And then lastly, we're going to introduce Options Play Portfolio. That's what we've been busy working on for the last few months. We're happy to announce that we're ready to allow users to use this portfolio functionality. So we'll talk a little bit about that towards the end of our webinar. So just to get started, we're going to talk a little bit about the basics and benefits of covered calls. This really is for those of you who are new. Covered calls is a strategy where you're selling calls against stock that you own in your account, and the strategy generates consistent income because of the premiums that you're receiving for the calls that you're selling. And what this does is it lowers the volatility of your portfolio as well as lowers the net cost basis of the stock that you own. And the best part about this is you use it on the existing stocks in your portfolio. You don't have to buy any new stocks. You don't have to buy anything new. You use the existing portfolio that you currently have with the stocks in it to generate additional income by selling covered calls on top of it. And there are some limitations to doing this, and what it does is by selling a call option, you are giving away the upside return of the stock above the strike price of that call option. So if you own Apple at $100, you sell a 140 call option, you are giving away any upside above $140 between now and expiration on Apple. So there are some limitations to that, and it does require at least 100 shares of the underlying stock in order to sell one call option. So if you have certain positions where you only have 50 shares or 80 shares, this is not a strategy that you can deploy on those stocks. It has to be on a stock that has at least 100 shares that you own of. And lastly, you do risk losing your stock. So depending on whether this is a taxable account or this is a tax-deferred account, you will have different tax implications if you do lose your stock because you do have to deliver that stock if the stock gets called away. So these are all the things to consider when you're deciding whether cover call opportunities is suitable for your portfolio. So let's get into how can you actually use this. And this is the one thing that we've been working on for the last couple of months because we've been talking a lot about the income opportunities and how it can benefit your portfolio. But we've been getting a lot of questions about how much can it benefit my portfolio, and we've been crunching these numbers, and we're very happy to report we've looked at over 15,000 cover call opportunities that either you or the financial advisors on our platform have been using to search for on our platform. We've looked at 15,000 trades, and it spans about 2 years worth of trades, and it spans over 1,400 symbols that each one of you have looked at using Options Play. And what we found is that out of those 15,000 cover calls that we're looking at, about 80% of them expired worthless. Specifically, 79.4% of those calls expired worthless, which means 4 out of the 5 calls that you guys looked at on Options Play expired worthless, where you kept the premium, where you kept the income on that cover call. So when we're talking about consistency, 4 out of 5 is a very good number to strive for when you're selling covered calls, so that you know that about 80% of the calls that you sell will expire worthless. So about 80% of the time you'll keep that income. And that's what's going to generate consistent income in your portfolio. Not only did we get 80% of the covered calls that expired worthless, but the average annualized return on those was about 4.61%. So the average annualized return net of all gains and losses was 4.61% in addition to the stock that you own and in addition to any dividends you might have gotten on the underlying stock. So this is just simply outperformance of the cover calls beyond what you would have received just by holding the underlying stock. And lastly, what we looked at is we looked at the performance over the months and looked at how consistent they were from month to month. And out of the 24 months over the last 2 years we've looked at, only 3 out of those 24 months resulted in a negative return on your cover calls. And this generally happens in a very strong bull market, meaning when the stocks are rallying very quickly, that's when we typically will see negative returns on covered calls. And it's not difficult. And what we saw was that in March of 2016, in November of 2016, and December of 2016, those are the 3 months that we saw negative performance on covered calls. And these were all particularly strong months on the S&P 500. November, December, which was the election last year, we had strong performance of the S&P 500 over those 2 months, so it wasn't too surprising to see those are the 2 of the negative months. And then March of 2016, which is also a particularly strong month where the S&P 500 was up about 6.6%, was also another month where cover calls underperformed holding the underlying stock. So those are the 3 out of 24 months that we saw negative returns, which again goes to show how consistent the returns on cover calls is over a long period of time. So I'm just happy to be able to give you guys some context into the performance of covered calls and how consistent they can provide income to your portfolio. So with that, let's talk about how we can actually do that for your portfolio. So number one, like I said before, covered calls is not a one-size-fits-all strategy. Each one of you is different, so we need to understand how you're different so that you can find the covered call opportunities that suits your portfolio. So number one, we talk about time frame, which is really how actively you trade. So if you're someone like me that has the time to look at their portfolio every single day and follow the option markets pretty much every single day, you're going to fall somewhere on the short end of the spectrum. So this is where you're looking at expiration dates anywhere from 1 month to a few weeks out to about 2 months out. So when we're talking about these two things, one second, when we're talking about these two things, we're really talking about how do you choose an expiration date and how do you choose a strike price for your covered calls, because those are the two things that you need to look for every time you want to sell a covered call, is what expiration and what strike price. So keep that in mind in terms of this will help you determine what the expiration you should be looking at and what's the strike price you need to be looking at. So for expiration date, again, when you're an active trader or someone who has the time to look at your accounts all the time like I do, you want to be on the more shorter end of the spectrum where you're going to be looking at expirations anywhere from a few weeks out to about 2 months out. On the other end of the spectrum, you have your investors this is what I call my long-term investors. These are buying and holding investors that really don't look at their accounts very often. You might look at your accounts once a month or maybe once a quarter. The suitable expiration dates for you is really somewhere from 3 to 6 months out. And then most of you probably fall somewhere in between, meaning you may not look at your accounts every single day. You might look at your accounts once a week or once every couple of weeks. You would fall under the medium-term category. So you want to search for expiration dates that are anywhere from 2 to 3 months out. So before we move forward, make a mental note to yourself, where do you fall under in terms of how actively you trade? Are you short, medium, or long-term? Okay? Once you make a mental note of that, let's move on to the next part, which is risk tolerance. Each one of you will have different risk tolerances. And when we talk about risk tolerance for covered calls, there's 3 main objectives when it comes to covered calls. You can either be, your main objective can be keeping your stock, which this is reserved for the users who are on this call, who are generally, you've owned stock for a long time. You have relatively low cost basis on the stock. This is stock that you don't want to lose because you've held on to it for a long time. Maybe it's been in your family for a while. Or it's dividend stocks where you rely on the dividend. So you need to make sure that you keep those stocks. If that's your main objective, then your risk tolerance would be on the conservative end of the spectrum when it comes to covered calls. On the other end of the spectrum, if your main I guess you could say objective is maximizing your return, you don't care if you lose the stock, you don't really care what the underlying stock really is, you just want to seek the maximum yield, you would fall under the aggressive end of the spectrum when it comes to risk tolerance. Now, the rest of you, which is, I would imagine most of you, will fall somewhere in between. That means you're looking for a nice balance between risk and income. And if that's your main objective, you want to seek somewhere in the optimal risk tolerance. So before we move on, make a mental note to yourself, both on time frame, where do you fall under, short, medium, or long term? And for risk tolerance, do you fall under the conservative, optimal, or aggressive risk tolerance? Once we have those two preferences, the rest is relatively easy. So we've talked about how to select an expiration date. That's simple. It depends on how actively you trade. When it comes to figuring out what strike price, that's also relatively easy. It's just finding a strike price that's based on your personal preferences. So we talked about 3 categories: conservative, optimal, and aggressive when it comes to your risk tolerance. So that's what's going to help you select your strike price. So when it comes to the conservative end of the spectrum, you want to search for strike prices that have approximately a 90% chance of expiring worthless. And for those of you who are not familiar with what that means, 90% probability of expiring worthless means that if you sell 10 calls, you should expect 9 of them to expire worthless, and 1 of those 10 calls results in your stock being called away. So for those of you who have never seen an indicator like that before, you may be more familiar with the concept of delta. So for a conservative trade, you're looking for approximately a 10 delta call. For the optimal spectrum, you want to search for approximately 80% probability of expiring worthless, or approximately a 20 delta call. So with an 80% probability of expiring worthless, you're expecting 4 out of those 5 calls to expire worthless, and 1 of them to result in your stock being called away, which is in line with what we're seeing on our platform over the 15,000 trades that you guys have all looked at on our platform. About 4 out of those 5 trades that you've all looked at expired worthless. They actually expired worthless, not just what our models are telling you. And then lastly, if you're on the aggressive end of the spectrum, you want to search for something with about a 70% probability of expiring worthless, or a 30 delta call. Now, this illustration that I have up here is really designed for if you're searching for it manually. The whole point of options play is so that you don't have to memorize this and look at your chain every single time and try to find the 10 delta, 20 delta, or 30 delta call, because there's a lot of manual work that requires to go pull up a chain, find the right expiration, find the right strike, then do some calculations to see if there's enough return or enough premium. Options Play does that all for you. So we're going to show you how to do that. So you don't have to memorize this. You just have to know, am I short, medium, and long term, or am I conservative, optimal, aggressive? That's all you need to remember, and then Options Play will help you find the right expiration and strike price. But the 2 crucial steps to inconsistent income is, number 1, choosing an expiration and strike price based on your preferences only. So if you're not able to find a cover call that meets your time frame and your risk tolerance exactly, that means don't do it. Don't try to trade something that's outside of your risk tolerance or outside of your time frame. And we'll show you how you can do that very easily in Options Play. Now, once you've honed in on the expiration and strike price, the second step to consistent income is checking your annualized return against the dividend yield. What do I mean by that? Every single time you look at a cover call, it will give you an annualized return. And we need to see if that annualized return is worth the risk that you're taking, the risk of losing your stock, the risk of giving away the upside above the strike price. There is some risk in that. So we want to understand, are you getting enough return for taking on that risk? And how do you determine if there's enough return? I usually use the dividend yield as my gauge. So if I have a stock that pays a 2% dividend, I want to try to get at least a 2% yield on my cover call for it to be worth my time. If I have a stock that pays a 5% dividend and I'm looking at a cover call that only pays me a 1% yield, that might not be worth my while because I'm only going to increase my yield from 5% to 6%. Might not be worth giving away the upside of the stock and potentially losing the stock for just an extra 1%. So use the dividend yield as your gauge. And today we've actually introduced a new tool on our platform that gives you a better gauge for understanding how much your total yield at the end of the year is with adding a cover call to your stock. So I'll show you that today. So with that, I'm just going to go ahead and bring up Options Play so that I can show you guys how to use what we've talked about today in practice on the Options Play platform. So this is Options Play, the platform. For those of you who are new, I'm just going to give a quick 2-minute demo. What we have here is a full trading platform designed to help quickly give you the information you need to seek option strategies for whether you're bullish, bearish, or looking for income opportunities. So what we have here on the left is trade ideas and watch lists. This is designed to quickly give you a list of symbols that you want to look at, whether it's fresh symbols that we've created for you based on bullish and bearish scans that we've scanned for, or your own watch list. You can use this to create a number of watch lists for yourself and very quickly see which symbols you're. The middle panel is our equity analytics panel, which is designed to help give you quick summary data of the underlying stock, everything to do with historical trends, relative strength indicators to let you know how strong the stock is compared to the overall market, as well as support and resistance levels on the drawn for you on the chart with things like earnings and dividends and price action, which are just important information to know before you place a trade. So once you have the underlying data, we have trading and income here on the right to very quickly help you determine viable strategies for whether you're bullish on the stock, whether you're bearish on the stock, or if you're looking for income. So today we're going to be focusing our time on income. So if you're ever looking to find an income opportunity on any stock, you just type in the stock and click on the income tab. Now, before we go any further, we talked about understanding your individual preferences. So before you go any further on any strategy, once you click on the income tab, click on the default settings here on the bottom. What this allows you to do is set those settings that we just talked about on both time frame and risk tolerance. So if, let's say, you fall under the short-term time frame and the optimal risk tolerance, you just go ahead and select short-term optimal and save as default. And you can also do this for puts as well. For those of you who do sell puts, this is a bit more advanced strategy that you can use as an alternative to acquiring the stock. You can actually set separate settings for short puts. So my particular settings for short puts is short-term aggressive, and my settings for calls is short-term optimal. And once I create the setting, OptionsPlay will do the rest of the work. We will search for the appropriate expiration and strike price that meets your criteria for both cover calls and short puts on any underlying stock. So here I set up a watch list. I call it a buy right watch list. These are stocks that either I own in my account or want to own in my account. So if you click on Netflix, what this does is it allows me to instantly provide me what is the starting point or what is the expiration and strike price that fits my criteria. In this particular case, Netflix is trading at around 145 and change. This is telling me that I can look at the April 7th 152.5 cover call. So about $7.50 out of the money. And what this allows me to do is type in the number of shares I own. So if I own 200 shares of Netflix, it immediately tells me that by selling the April 7th 152.5 cover calls, I will receive $142 in premium, and they produce a 7.7% annualized return on this cover call with an 84% chance that this call is going to expire worthless. So it gives me all of these relevant stats that I need to understand which cover calls should I be trading, and what is the return that I'm going to get if I trade these stocks, and what should I expect in terms of the probability that this call will expire worthless and that I will keep my my return. So in this particular case, it's telling me that I'm going to get an average annualized return of 7.76% and a 12-month projected yield of 7.76%. That's because this stock pays 0 dividends. So my total yield is just what I'm getting on the cover call. So what that means is that if I just held this stock and I didn't do anything with it, I would get a 0% yield because the stock does not pay any dividends. However, if I add a cover call on top of it, I can earn approximately 7.76% over the span of the year as I continuously sell cover calls across the year. So this is telling me that I can increase my yield from holding the stock from 1% to approximately 7.5%. So this is certainly a trade that I would consider taking a look at if I own Netflix stock. And then what this tool allows you to do is once you've created a watch list with all your holdings or the list of stocks that you want to own, this allows you to instantly click on a trade or click on a symbol and immediately know what is a viable starting point for yourself that's based on your personal preferences when it comes to writing cover calls. So here on Boeing, if let's say I also own 200 shares of Boeing, I immediately know without ever having to pull up a chain or do any manual searching myself, I know that the April 7th 185 cover calls, which for a stock that's trading at 178 right now, so this call is about $7 out of the money. It expires in 23 days. It's going to give me a 6.75% annualized return on the cover call with a 9.19% projected yield because this stock pays a 2.44% dividend yield. So this 12-month projected yield is a new indicator that we've just added. This gives you an idea of the total yield you should expect by owning the stock and adding cover calls on top of it. So you're taking your yield from 2.44% from just owning the stock to about 9.1% by adding cover calls. So that's the benefit of adding cover calls to this strategy, and you now know that there's about approximately a 79 or 80% chance that this call will expire worthless. And this is designed to save you time. So if you're trying to write cover calls in your portfolio and you don't have the time to pull up an option chain on every single symbol that you own and have to search for the expiration date and the strike price and then manually crunch the returns and see if they're high enough, this tool is designed for you to quickly scan every single stock in your portfolio, click on it, and within seconds know what is the correct starting point for you for cover calls. So in this particular case, if you own Apple, which is a stock that most of you probably own in your portfolio, it allows you to, within seconds, to know which cover call that you can sell, exactly how much premium you'll receive, and what your expected total yield of this strategy is for your portfolio along with the probability metrics that you need to decide whether or not this cover call suits your risk profile or not. And this is designed, again, to help you quickly identify if there's a cover call opportunity, such as in this particular case, when you get a green check mark, that means we were able to find you a cover call on Apple and Netflix and Boeing. However, on certain other stocks, I do want to show you, and when we talked about the two crucial steps of writing cover calls is only sticking to the expiration and strike price based on your personal preferences. So when you see a green check mark like we do here on Bank of America, that means we're able to find you a cover call or a short put based on your personal preferences. And I just want to see if I can find you one where we couldn't, which is also the case. So here on Sprint, which is a relatively low price stock, there's not a ton of premium in this stock. It doesn't move a ton from a percentage standpoint. As you can see, I get a slightly different message here. If I own Sprint, let's say I own 300 shares of Sprint, as you can see, I get a slightly different message. I don't get the green check mark. So what this is telling me is that Options Play could not find a cover call based on my personal preferences, which is short-term optimal, and it's displaying to me the next best alternative. In this particular case, it's a long-term optimal. So what this allows me to do is quickly understand, A, is there a cover call that suits my needs? And if there is, I get a green check mark. If there isn't, I get this warning sign that just tells me, hey, we couldn't find you something. I suggest for those of you that are new to Options Play or new to cover call selling, that if you get this message that says we couldn't find you the optimal cover call based on your settings, that just means move on. You don't have to spend any more time on Sprint. Move on to the next stock. See if you can find a cover call opportunity on the next stock in your account. And this is designed so that you can go through a list of 20, 30, 40 in a matter of minutes and know exactly which stocks have income opportunities and which ones don't. This is designed so that you can go through a huge portfolio in a matter of minutes and know exactly when to sell a cover call, when to not get into a cover call without ever having to pull up a chain. And that's really the beauty of Options Play and what we created, is to still provide you with the same opportunities that you would get if you had to search for them manually, but doing it in a way so that it lowers your chance of errors because it's already selecting the expiration and strike price based on your personal preferences. And it really doesn't allow for a lot of variability because sometimes you might from time to time select strikes that are inappropriate for your risk profile or select expirations further out than you really should because there wasn't enough premium. This is designed as also a validation check. So once you've looked at the trade that you want to make, let's say you own 500 shares of Microsoft and you're seeing that you want to sell the April 13, 66.5 cover calls, once you hit trade, we have what's called a strategy checklist, just to make sure, especially for those of you that are new, make sure you understand exactly the trade that you want to make. We provide you with the details so that you can enter it into your brokerage firm so you know that you're entering the correct trade. This is something also that we see some, especially beginners, will struggle with, is understanding how to enter these trades correctly into your platform. If you're new to options trading, make sure you follow our instructions exactly so that you're not entering the wrong trade. And then what we do is we provide a strategy checklist just so you understand some of the risks and not make the same mistakes that we made as options traders when we didn't have tools like this, such as understanding, is the probability of expiring worthless on your call good? Is the annualized return good? Is there earnings between now and expiration? That's something that we see a lot of users kind of overlook, is there earnings or dividends between expiration. So these are all the things that we are looking at to make sure that you understand the risks that you're taking, especially when it comes to the spread or how liquid something is. So in this particular case, this Microsoft call actually isn't very liquid. So it's just giving you a warning to let you know that you should try to place your limit prices near that mid price for execution. So this is all designed to not only help you make better trades, but also make sure that you understand all the risks that you're taking before you place a trade. So again, just to summarize, for those of you that are looking for income opportunities to add to your portfolio, I recommend that you set up a watch list with all the stocks that you either own in your account or that you want to own in your account. And all you have to do is go to the income tab, create your settings so that you can select a time frame and risk tolerance that suits you, and then save as default. And then all you have to do is click on a symbol that you own, and you will immediately, within seconds, know if there's a cover call opportunity that suits you or not. And then look at the underlying statistics to see, are you increasing your yield from 1.39% on Disney to 6.21% by adding a cover call? Great, and you have an 81% chance that this call is going to expire worthless, and you know exactly what you're expecting for this cover call, and then placing a trade by clicking on the trade button so that you know exactly how to enter this trade into your broker's platform before you go ahead and execute that. So this is all designed to help you guys quickly identify the income opportunity that best suits you, and then at the same time help you avoid mistakes and automating this whole process for you so that you can do this no matter how little time that you have. If you only look at your account once a month, then you only have to pull up OptionsPlay once a month, put in the stocks that you own that you don't have a cover call position on, and within minutes know what you can execute in that account, and then come back once those calls expire worthless, or if you get assigned or if you need to roll them, come back to the platform and do the exact same exercise, because that will allow you to very quickly manage your cover call opportunities in your account. And I do want to talk a little bit about, just especially for those of you who have to make minor adjustments. What I mean by that is you may have settings like me, short-term optimal for most of your stocks, or that's where you find yourself to fall under as short-term optimal. But you may have certain stocks that just one or two stocks maybe you own for a long time and you don't want to lose, or maybe it's possible that you have stocks that you rely on dividends that you really don't want to lose those stocks to a cover call. Then what I want to do is show you guys how you can make some minor adjustments. And I think Apple is a good example, because for those of you that own Apple, maybe some of you have owned them at a relatively low cost basis, and you really want to hang on to the stock because you think the stock can really still take off, like a lot of you do. So if, let's say you own a couple of hundred shares of Apple, this is telling you that it's trading at 140 right now. This is telling you to sell the April 7th 145 cover call. So it's about $4.50 out of the money in the next 23 days, which for Apple is not that crazy. So if, let's say, you need to make some adjustments, maybe you want to be more conservative on Apple, you can pull up what's here on the bottom called Options Grid, and you can look at the other time frames and the other aggressiveness levels to look at and see what are your alternatives. So if, let's say, I've owned Apple for a long time and I really don't want to lose it, I can look at April 7th 147 cover call, which is the conservative end of the spectrum. And this is telling me what my relative stats here. So for the 145s, I'm going to receive $92 in premium, about a 5.2% annualized return, a total yield of 6.8% with an 83% chance this call is going to expire worthless. So instead, if, let's say, I want to be conservative on this call, I can move it up to the 147s. So now I'm only getting $48 in premium per contract. But as you can see, my annualized return reduces down to a 2.71% for a total yield of 4.3%. So not as attractive on the yield perspective, but now I have a 91% chance that this call is going to expire worthless. So I'm fairly certain, or much more certain, that this call is going to expire worthless for the conservative end of the spectrum than I am going to be for the optimal end of the spectrum. So for those of you that need to make minor adjustments, come down to the bottom here where you see this options grid, and then you can see the full grid and see how, if you need to make adjustments by going further out in time, or you want to go more aggressive or less aggressive. This gives you a similar view that the chains do, but it's already pre-filtered for you so that you're only getting ones that sort of make, as opposed to having to look through every single option that's available to you on the chain. Which if you do, if you want to look at that, you just click on the modify button, and then you can see the full chain and look at all the strikes that are available and what the premiums you'll get for each one. And we've even marked off the one standard deviation move for you on both ends of the spectrum, so you know relatively where you're selecting your strikes based on standard deviations. So with that, I'm just going to go back to the sheet and finish up what we were talking about, which is the exit scenario. So once we've talked about the benefits of cover calls, and many of you have traded cover calls, but still one of the most the reoccurring questions that we get is, what do you do with the cover call once you're in it? And essentially, you have three scenarios that can happen with the underlying stock, and we want to cover those three and what you should do with those cover calls. So you can own the stock and sell a cover call, and the stock can either go higher, sideways, or lower. Those are your three major scenarios that you need to account for when you're selling covered calls. So the least or the hardest one to decide as to what you should do is if the stock really goes higher, because you may have a unrealized loss on the covered call. You're going to have a nice gain on the underlying stock, but you have potentially what could be an unrealized loss on the covered call. And this is the part where a lot of users will tend to panic a little and not know what to do. You may want to close out that covered call to make sure that you don't lose any more on that covered call. And this is really the one scenario where it's best to not panic and hold on to your covered call until the last week of expiration. So if you sold an April call and the stock goes higher, like in this case of Apple, if Apple goes up to 145 or 147, what you generally want to do is hold that covered call till the end, close to expiration, before you roll that covered call, because by doing so, you're going to be able to capture that time decay, which if you roll too early, you're immediately losing that time value, and you're essentially locking in the loss. By holding it till expiration or the last week of expiration, you're allowing the stock to potentially come back down and potentially go below the strike price, and you're also at the same time capturing that time decay between now and the last week of expiration, which is really what the whole point of this strategy. So if the stock goes higher, try not to panic, hold on to that covered call until the last week, and if you have and if it's above the strike price in that last week, then you can roll it out further to a higher strike price to do again over the next week or the next month or the next quarter, depending on how often you roll these covered calls. So that's the hardest scenario as to figure out what to do. If the stock goes sideways, that's probably the easiest scenario. Essentially, what you want to do is just hold your covered call until expiration, let it expire worthless, and try to do it again the next month or next quarter, depending on how often you trade these covered calls. And lastly, if the stock goes lower, this is kind of a best case scenario for the covered call. It's a worst case scenario for the underlying stock, but this is the only time where it makes sense to roll down your position early. So if we sold that 145 covered calls on Apple and next week it plummets down to 130, that 145 call that you've sold is essentially worthless at that point. So what you really want to do is lock in that profit and roll it down. Maybe you might roll that covered call down to a 135 and try to capture some more premium. So those are the three major scenarios of what can happen once you write a covered call, and these are the three methods and how you can deal with each one of those scenarios. So with that, I've covered what I want to show you guys in regards to what the covered call strategy is, how you can identify the best preferences for your personal portfolio, but most importantly, how you can utilize that and implement that for your own portfolios using the OptionsPlay platform. So with that, what I'll do is I'll open this up for Q&A. And for those of you who have any questions, just type them into the chat window, and I'll be able to answer any of those questions. And it looks like I have a few questions ready from the webinar, so I'll tackle some of those. And let's see. I have a question here asking what's the best probability of success or lowest cost. So that's where you don't want to think about this in terms of what's best. You want to think about how do you find covered calls that only match your portfolio needs. So this is what I mean. Covered calls is not a one-size-fits-all strategy. Each one of you is different. So select the expiration and strike price based on your own preferences. That's the best thing to do. So if you are active, select short-term expirations. If you're conservative, make sure you select this conservative risk tolerance and only stick to those covered calls, because that's what's best suited for your portfolio. There's no such thing as the best probability of success for anyone. It's all depending on your personal preferences, and that's what our platform allows you to do. Is we're not telling you what's best. We're helping you find what's best for your portfolio. So great question. Larry's asking, if you set a limit, is it okay to keep the trade active on a good till cancel, or only run the trade for the day? Great question, actually. So this is more along the lines of how to manage your executions. Larry, my best suggestion for you is do a day order, because by the next day the prices may have moved, and maybe you might be selling. It's best for you to be selling a different strike price. So I do recommend that if you do a limit order for some of these covered calls and they don't get filled, come back the next day and see if the strike prices have changed. Maybe it's better to trade a different strike price and enter a completely different trade. So I would suggest at least every day, if not every other day, come back, and if something doesn't get executed, use the new strike price or new price, if you will, for entering the order. Gary's asking, do you have an API to enter trades directly into my trading platform? So Gary, that depends on your trading platform. Let us know. We do have integration with some platforms, but at this point, you're going to have to enter these trades manually into your own broker's platform. I have a question asking, how do you find the optimal option? So that's really coming down here to select the time frame and risk tolerance. So this is at the bottom of the income tab. So for those of you that missed it, when you click on the income tab, there's going to be a default settings here on the bottom that allows you to select time frame and risk tolerance. So you just select the correct time frame for you and the correct risk tolerance and click on save as default. And all the cover calls that we find will be based on the settings that you create. Yes, this recording will be, or this webinar is recorded. So for everyone that's registered, you will be receiving an email after this for the entire webinar, and you can view it at your own pace and use it to look at your own pace and view it as many times as you like. So yes, this will be recorded and sent out to everyone. I have one question asking about the put side, which is a good part. So for those of you that are using short puts or familiar with short puts, it's an alternative to buying the stock. So instead of buying Bank of America at 25.18, if you think it's too rich, one of the things that you can do is you can sell a put, and by receiving, what that really does is it's almost like putting in a limit order at the strike price. So you're basically putting in a limit order at 24.50, and for doing so, you're going to receive some income for doing it. And if the stock doesn't go below 24.50, you keep that income and you can do it again. And you do it month after month until you get executed on the stock at the price that you wanted, and you can sell a 24 put, you can sell a 23 put, and you just get less and less premium the lower you go. And this is if you really want to get executed, you can sell an at the money put. This will increase your chances of getting executed. So you'll buy it at 18 cents cheaper. And you're going to receive $44 in premium. So you're actually getting it for significantly cheaper if it does go below $25 at expiration. So this is certainly a strategy for those of you who, I think Snapchat was a great example of this. A lot of people didn't want to buy Snapchat at its IPO price or even at the current price that it's trading at. Selling put there was a lot of premium in them. So that was also an alternative that you can do to own the stock, is to sell puts. And then you can also add calls on top of that. So you can sell the 25 put for 44 cents, and then you can buy a 25 call. And what that will also do at the same time is it gives you that upside. The stock really just takes off, and it never goes below that strike price that you can sell the puts at. Selling a put and going along call is also known as a synthetic stock strategy, which is a bit more advanced strategy. But for those of you that are selling puts, you're probably looking at some of the more advanced strategies. It's certainly one strategy you can look at. A great question here by Abe. If the stock rises above or beyond the sold strike price before expiration, will I get assigned? Great question. So, and the answer to that question is very, very, very rarely. Will that happen early? Meaning it will usually happen at expiration, meaning if the stock is above your strike price at expiration, then you will likely get assigned. But it will very rarely will it get assigned before expiration, which is why even if the stock goes beyond the strike price, I'm telling you, try to hold on to that call until the last week. But as you get closer to expiration, that increases your chances of getting assigned. So we usually try to roll your cover call within 3-4 days out before expiration, so you have plenty of time to get that execution of getting out of your cover call and rolling it out to the next expiration. Great question there. Larry's asking, is there a link to just download the slides? Sure. So what I'll do is I'll actually include the slide presentation for everyone in the email with the recording of the webinar. I have a question asking about adding the cost per share and purchase date, and then it would calculate returns if it's called away. So that's certainly something that we are currently in the process of looking to add. So Vincent, thanks for that. We're definitely looking at adding that for everyone. Vincent's also asking a question if there's going to be a replay on our YouTube channel, and there certainly will be. So we'll be uploading that to our YouTube channel and sending everyone a link once we have that recording up later tonight. Vincent, your other question regarding Chaikin, we'll talk about that offline. You can ask me, you can send me an email specifically about that offline. Gary, thanks very much. James is asking, how do we determine our standard deviation? So that's actually a model that we created on our own. We built our own probability models here based on implied volatility of the option for each expiration to calculate what is the one standard deviation move for each expiration. And we're very happy to show that over the last 2 years our models have been accurate. When we say that there's about an 80% chance of expiring worthless on our cover calls, we see that they're approximately, in reality, they're about 82 to 83% of them expire worthless. So our probability models are actually slightly more conservative and giving you what we consider very accurate, I guess you could say, models of what probability will actually look like upon expiration. Vincent's asking about rolls, which is a good question, right? So, and let's just go through a real life example. So, and I think Apple is a good one to use. So Apple's trading at 140 right now. Based on the cover calls that we're looking at, this is telling me to look at the April 7th, 145 cover calls. And the question is, what happens on a roll? So if, let's say, on April 7th or April 6th, a few days before expiration, Apple's trading at 145, 146, I'm at risk of assignment and I need to know what to do, all I have to do is come back to options play, type in Apple, and this will spit out a new cover call for me to sell. At that point, it will probably tell me to sell a May 150 or 151, something along those lines. And that's whatever it spits out then, that's what you want to roll the April 7th 145 to the May 150s or whatever call options play will spit out at that time. So come back to the platform and just type in the symbol when it's time to roll, and it will give you the recommendation in terms of the appropriate call to roll to. So great question on that. David's asking, and this is a great question, regarding assignment, don't chances increase if a stock goes ex-dividend during the holding period? And that's absolutely correct, David, is that you are at higher risk of early assignment if it goes ex-div. However, it's only at risk of assignment if the dividend amount is greater than the extrinsic value of the call. That's the only time where it makes sense to exercise early to capture that dividend. So that in those particular cases, you do have an increased chance, but it's still relatively rare. And that's actually one of the things that our portfolio functionality will scan for, and that's something that I'm very happy to announce that we're ready to start taking users on our portfolio functionality, which will not only help you find the correct trades to make, but also look at your existing portfolio and see both the equity and option positions and let you know if you're at risk of assignment. So that's certainly something that we need to be aware of, but it's not easy to scan for. If the extrinsic value of your cover call is greater than the dividend amount, That takes a lot of manual work to figure out. So that's what we're hoping to do in an automated fashion with our portfolio functionality. So looking forward to having that available to everyone here to test. Any other questions? I have a few other questions regarding, Chaikin and other platforms. So for those of you that have questions about some of our other platforms that are embedded into other platforms, please send me an email separately about that, and we can talk about that. I don't want to cover that on a webinar specific to cover calls. Any other questions regarding cover calls or how to find the right cover call that suits your needs on the OptionsPlay platform? Bruno, great question. So some of you here are on this webinar are on a free trial at OptionsPlay. I'm happy to let you know that you're seeing the exact same thing that you would get if you are a paid subscriber. So you are getting the full presentation or you're getting the full platform during your free trial, so that you know exactly what you'll be getting once you start your paid subscription. Again, one last, how do you find the most fruitful calls? There's no such thing as the most fruitful calls. The best calls is the ones that suit your personal preferences, which is, again, finding the right time frame for how actively you trade and finding the risk tolerance based on your personal risk tolerance. There is no such thing as the best cover calls. The cover calls is not a one-size-fits-all strategy. Stick to what suits you, and that's where you're going to find the best performance. So use the default settings here for both time frame and risk tolerance, and that will yield you the best results for your portfolio. Any more questions regarding cover calls? And I want to thank all of you who are attending here this afternoon and taking the time out and listening to us talk about this strategy, because it's certainly a strategy that we're seeing, after we've crunched these numbers over the last 2 years, we're certainly seeing good performance of this strategy for those of you who are adding it to your portfolios. We're seeing financial advisors use this platform to add cover calls for their individual their clients. So you can utilize the same tool that these financial advisors are using to add yield to their portfolios in your personal accounts. So, now that we've crunched these numbers, we're very happy to report the numbers are quite substantial and consistent, and that's really the key to this. Only 3 out of 4 months we've seen negative performance on cover calls, which shows how great or how consistent the returns of adding a cover call strategy to your portfolio is. So definitely consider adding this to your portfolio if you're new to this strategy, and for those of you that are trading cover calls, use this tool to help you methodically choose the strategies that fit your portfolios. And if there aren't any more questions, I'm just going to go ahead and end this presentation and make sure that we have the recording for everyone. And like I said, you'll get an email from us later tonight once the recording is ready to be able to view at your own pace. Thanks everyone for taking the time out this afternoon, and we'll be back in the next couple of weeks to do some more webinars on trading strategies with OptionsPlay. Thanks everyone for joining us this afternoon. Have a good evening.